Good morning all. Geoff Catt is my name. I'm one of the principals here at Prescott Securities in Adelaide. The main activity, of course, in the last week has been the release of the 2013-14 federal budget, and there will be a link on our website, of course, to our annual budget breakfast, which was held here last Wednesday morning. 250 odd people. It was a great success, we think, and if you link into there, you'll see all of our comments from Darryl Gobbett, our group economist. But just a couple of points that I pulled out for my particular clients for those nearing retirement in the budget. I think the main thing is if you're still contributing to superannuation, of course, the ability now, if you're age 59 and over at the 1st of July, you'll be able to contribute $35,000 next year into superannuation as a tax-deductible contribution rather than the 25, which it is at the moment. And for those younger ones who are 50 and over, you'll be able to do the same thing from 1st of July 2014. I think that's a good thing for the government to do, to get back to where we used to be with higher concessional contribution limits in the past. Also, the government did announce that it will no longer tax excess concessional contributions at the rate of 46.5%. That was pretty a strong penalty, I think, but from now on, if you do contribute extra, it will only be taxed at your marginal rate rather than the 46.5%. That's the way it should always have been, I think. For those in retirement, two things. Number one is, from 1st of January 2015, any new pensions that start from that date, pensions drawn from your superannuation that is, the income will be deemed in the same way as income from shares or term deposits, cash, anything else, for Centrelink purposes. So if you're in receipt of an age pension, or likely to be, and you want to continue to receive the more favourable treatment of the income from an account-based pension from your super, talk to your advisor, and if it's possible or appropriate to do so, you may well look at starting those before 1st of January 2015. The other interesting one that was introduced was the ability for people in retirement, and again who are impacted by Centrelink assets test, if you wish to downsize from your family home, there is going to be a pilot scheme where if you sell your home, move to something smaller and realise some capital, you'll be able to put up to $200,000 into a special type of account, and as long as it remains in that account, then that money will not be counted as an asset. Previously, if you sold your home, went to something smaller, you ended up with a lump sum of money, and that money would be counted as an asset for Centrelink and may well result in a reduced pension. So that's a good system. If you think you're going to be in that scenario, talk to your advisor once again, and we'll see if that can be of some benefit. And of course, the final thing was the increase in the Medicare levy from 1.5% to 2% to fund the National Disability Insurance Scheme, known as Disability Care Australia. So they're the main ones that came out for both those approaching retirement and those in retirement. The implication for Australian investment assets, it's really hard to see any significant major impact on assets. Cash and term deposit rates, we think, will still continue to come down, with 5-year bond rates or yields at around 2.8% at the moment. We're unlikely to see anything change there, so we're not particularly excited about the potential return from Australian sovereign bonds over the next few years. And whilst there's been some allocation to spending perhaps on roads and rail and other infrastructure, there may be some impact on building materials, construction companies, but really we can't see a significant impact on the share market going forward. Property prices, on the other hand, are probably likely to continue gaining at some sort of modest pace, with low interest rates and domestic growth starting to pick up a bit. But the one interesting move has been, of course, the Australian dollar, and everyone's been saying the Australian dollar's been falling, but in reality it's the US dollar strengthening. If you look at the cross rates, not a lot of movement, but against the US dollar, and as of last Friday night, our dollar came down to 97.1 US cents, which was the lowest level since about June 2012. But of course, the US dollar has rallied over that same period, and it passed 103 Japanese yen, for example, for the first time since 2008. Now, the Dow Jones index and the S&P were closed at fresh all-time highs on Friday. They were up about 1%. And I really just come back to the graphs that we continue to produce here at Prescott, which shows the Australian share price and the US share price against Australian corporate profits and US corporate profits. And I know this is available from your advisor, but what you can see here is the red lines indicate the movement of the markets, and the blue shaded area indicates the historic, and also in light blue the forecast corporate profits from those two countries, US and Australia. And you can see in both cases we've got a fair way to go, but in the US, of course, the US market has recovered significantly more than the Australian market. Now, at some point in time, theory would suggest that the red line will be back up where the blue is, right up here, which is a significant increase, but when that's likely to happen, we just can't forecast. But it does give us some confidence that the Australian market, in time, has still got a fair bit of valuation left in it. So that's it for us. Thank you very much, and we'll catch up with you next week.